The Four Pillars of Investing by William Bernstein. This book really gets into the meat of the understanding of how investments on the stock market, how investment options work, and which ones could be best if you want to be a successful investor, which is what it takes to develop wealth over time. Risk is necessary for high returns in investments. But you have to know when to take the risk, and you have to know how to take less risk by diversifying and by understanding your investments and taking the right ones. Value stocks are stocks that are at lower costs but have a bigger potential to earn, and they earn more but they're more risk. They're from weaker companies that haven't shown the strength over time, companies that may be undervalued but are growing, but there's risk that they can go the other way. Growth stocks are stocks from companies that consistently grown over time. They usually earn less, but they are less risk because they're from stronger companies over time. You need a mixture of value and growth stocks in your portfolio for an effective portfolio. You have to beat inflation, fees, and taxes over time to become wealthy from investing. How do you do that? By having the right mix, taking the right amount of risk, and setting up ways where you don't lose that much money in economic downturns. Small companies tend to grow more. They can have explosive growth. The investments in small companies, stocks in small companies can explosively grow, but they also can fail. Larger companies are safer. They usually grow less. So it's really a common idea here. The more risk you take, the more upside you have. The less risk you take, the smaller the upside. Stocks in general are risky. You can mitigate the risk of stocks by offsetting them with bonds, real estate, and other investments, and just holding cash. There are four market classes: small value, small growth, large value, and large growth. So small companies that are undervalued, small companies that are consistently growing, large companies that are undervalued, and large companies that are consistently growing. This is the safest stock you can buy. This is the riskiest. This has the biggest upside. This has the lowest upside. You really want to split them. You want to index them. There are indexes where you buy large amounts of each of these classes and just try to buy all the amounts of each of these classes, and then you don't have to pay the fees that would be associated with mutual funds. Put them in tax-deferred accounts because they will grow, and you don't want to pay the taxes. Roth accounts, traditional IRA accounts. These are accounts that can grow with tax avoidance. Brokers are not your friend. They all have an agenda. They're really just salesmen. They're not paid on your performance. They're paid on what they sell. They're going to be selling things that are good for them. So really, what you should do with your brokers, you need to just tell your brokers what to buy, and they just buy it. We need to take more ownership on our portfolios and more understanding. We can take some advice from the brokers. We should always be questioning what their motivation is. Downturns, throughout history, there are depressions and recessions in American history throughout time, but the American stock market has always gone up over time. It's always gone up. There may be downsides going along, but it's always going up. So you just got to wait out the downturns. You don't want to retire during a downturn because that's really going to hurt your portfolio. It's really best to retire during a bull market for sure. But expect a couple downturns, and those are opportunities that you have cash set aside for investing. You can buy at that time and get many, many more shares of your stocks, and then when it goes back up, you make huge gains in wealth. Like I said, retire during bull markets. You want to be able to live off of 3% of your portfolio. If you live off 3% of your portfolio, your growth minus your taxes and fees, you should be able to maintain your portfolio and not lose your nest egg of money. And then you have something to pass on to your children or your charities or whatever it is you want to do. So you want a portfolio big enough that you can live off 3% of it, 3% of the growth. You cannot save enough, save as much as possible. It's great to save in short-term taxable accounts that will grow, money market accounts, certain bond accounts, things like that, where your money is still growing, but at a slower rate and a safer rate. Bonds are great to put in taxable accounts because they grow less and they're tax-friendly. Put your stocks in your non-taxable accounts and your bonds in your taxable accounts, and that should save you a lot on taxes. Dollar cost averaging is a great technique. That basically means you buy the same amount of stocks and bonds no matter what's going on in the market each and every month. You do that consistently. That way when the market goes down, you're getting more shares, and it'll make back when it goes back up, you'll make up what you've lost. Dollar cost averaging is a great way to mitigate your risk for long-term investing. Unfortunately, most people try to time the market, and that just doesn't work very well. Final thoughts: if you really want to dig into investing, this is a great book to read. It's probably important. So many of us have IRA accounts, Roth accounts, or young people just starting out. With the power of compound interest, you could start this process right away and make incredible wealth over your lifetime at a relatively early age if you start it while you're young. But this is a very valuable book in terms of getting into the technicalities and the techniques of effective investing. And of course, the more we understand, the more we learn, the better investments we're going to be able to make, and the momentum we're going to be able to get in terms of achieving the financial independence and wealth that we desire.